Okay, good morning everyone. Welcome back to another webinar, looking ahead at real estate and construction here at BDO in Australia. My name is Reith. I'm BDO's National Leader for Real Estate and Construction, and looking forward to hosting today's webinar session on funding for the future. We'll introduce the panel in a minute, but before we do so, the usual housekeeping rules. You'll see the slides come up there. So yes, everyone is muted, but we do ask that questions be raised. Happy to hear your questions. Please just type them into that question box. If you have any technical difficulties, there's a button at the bottom where you can ask for help. And of course, the webinar session will be recorded. You'll get an email at the end with the speaker details, the recording session, and the access to future sessions. Okay, so let's get into it. So the construction industry, as we know, accounts for 25% of all business insolvency in Australia. An issue that's often resulted from low margins and difficulty in sourcing of funds. So the topic of sourcing of funds is a main issue for construction companies, and we will look at that today. And obviously, in the current climate, it's never been as important. So we'll look at this topic from the perspective of two non-bank lenders. We have with us Moelis Australia and also Centuria Bass. We'll introduce the speakers now. So we're waiting on Drew Bowie. So let's go to the two speakers that you can see, Nick and Charlie from Centuria Bass. Nick Goh is the founding partner of Centuria Bass.
G'day everyone.
Has over 23 years of experience in investment banking and funds management. Nick previously was managing director with leading boutique investment banks, Gresham Partners and Wingate Group, establishing and heading the divisions delivering mid-market investments, high-yielding lending and placements. Charlie also joins us from Centuria Bass. Charlie Robertson, g'day. He joined Centuria Bass in 2021 as Executive Director within the deal origination team, with over 20 years experience in origination, property development, investment and funds management. Welcome to the panel.
Good morning, thank you.
Great. We should also have Drew Bowie join us any minute. He was on the call earlier. We're just having some technical difficulties, but he should be on the call. He's the Managing Director at MA Financial Group. I remember them as Moelis Australia. MA Financial Group are an ASX listed financial services firm specialising in asset management, lending, corporate advisory and equities. It has over 7.2 billion in assets under management, most of which are in real estate. Drew leads the real estate credit investment within MA Financial, and his team has provided in excess of $2.5 billion to 250 individual real estate loan facilities over the last 5 years. Drew himself has over 30 years of experience in the valuation and financing of real estate in Australia and has delivered end-to-end structured finance over a diverse range of development projects and investment loans. We look forward to having him join us. So really today we want to look at the various perspectives of lending into the construction area. We want to dive into what borrowers need to do to access funding, tips and tricks, and the challenges of getting funding, and choosing a non-bank versus a traditional lender. We might get started, hoping that Drew can join us any minute. But I think with Charlie, we can cover off on most of the topics anyway. So here we go. So look, we know that the construction industry has been tumultuous, low profit margins, labour instability, a high dependency on construction loans. And these issues have only worsened with COVID-19. And the industry is still in the middle of recovery. It seems that every 2 weeks we see a media headline suggesting that another Australian developer has collapsed. So, in fact, I haven't introduced Duncan. I'm sorry, Duncan. Duncan is one of my fellow partners here. He's sitting across from me, and he's one of the partners here in our business restructuring teams. Duncan has over 20 years experience in providing restructuring and insolvency services and other to financiers and other key stakeholders. Duncan has extensive experience in the real estate and construction sector, having sold in excess of $1 billion worth of property over the course of his career in his capacity as receiver and manager. Sorry, Duncan, but let's start off with you. Duncan, tell us about the current state of the construction industry and what is driving the uncertainty in the market today.
Thanks, Andreas. Hello, everybody. Duncan Clubb from BDO Restructuring here. It's been a really interesting time in the construction space. They've been basically hit by a perfect storm of factors, which is for an industry which has operated, as you suggested, at historically low margins, have meant that there's not been the ability to absorb one, let alone the many factors that have impacted the industry. Basically, you've got an industry that operates on fixed price contracts, which has then been hit by and low margins, which has been hit by supply increase, adverse weather events, labour shortages, increasing interest rates, and it has all meant that low margin has evaporated, and you've got your likes of ProBuild collapsing on what for a while there felt like almost weekly basis. It's not all doom and gloom for the sector though, because we're starting to come out the other side of that already as those fixed price contracts have started to work through. So the businesses that have been able to work through have still got the benefit of that increased demand for construction services across the country, and the floods, which are both a blessing and a curse, have meant for the industry, have meant that labour has moved to those areas, which is creating labour shortages in other areas. So we're seeing construction companies struggle to resource their existing contracts. So there's been a multitude of issues that have affected the industry, but as I said, it's not all doom and gloom. The challenge, though, is for those construction companies who are left, demonstrating that you've got the balance sheet strength to operate in the new climate, and that new climate is seeing financiers such as the guys that we've got on the line, the big four, pay a lot more interest in how strong your builder is as part of any sort of tripartite agreement to be able to deliver on those contracts. So it's a really dynamic sector over the last 2 years. There's been a lot of change, but there is still a lot of opportunity going forwards. So that, I guess, is one of the reasons why we were so keen to have this webinar today, is that it's a very, very relevant topic, and it's a space that has changed a lot in the last 2 years and the last 10 years.
Yeah. So, Nick, did you have anything to add to that sort of upfront comment around the industry?
Yeah, look, some observations on some of the points that Duncan's made. So the starting point about pain points and what we're seeing in the market with the intersection of capital drying up because of both the Ukraine and rate rises. We're seeing the perfect storm in construction in Australia, and all of that sounds like bad news. But the good news is it could be worse for borrowers, because if we compare where borrowers are today versus where they were at the beginning of the financial crisis, we have a significantly greater participation of non-bank lenders in the sector. So gradually we're seeing non-bank lenders increase their market share. And certainly Australia is one of the markets where non-bank lenders have one of the lowest market shares in the OECD. So if you compare us to the US and Europe, non-bank lenders across many fields have upwards of 50% market share in areas like construction lending. So probably one of the key points I'd like to make is non-bank lenders such as ourselves and Moelis. And across the Centuria Group, we have nearly 22 billion of funds under management. In credit alone, we have $1 billion. And we're here to do things that the banks can't. And effectively, at the end of the financial crisis, when the market was even more highly concentrated with bank lenders, and we saw a real retreat of capital at all levels and across all areas, equity, debt, mezzanine. We saw that retreat of capital. stimulated by pretty much the financial crisis and bank-to-bank lending. Now what we're seeing are banks concerned about the health of borrowers, and a part of that relates to the fact that it's harder for banks to do the level of diligence required on a project that we are able to do. So for all of the issues you may see that are in the market, there are private lenders that are stepping into those gaps, and certainly there are problems for borrowers. Borrowers need advice and need advisors and need intermediaries to assist them. But I think one of the key points I'd say is there are a lot of businesses such as ourselves that have now evolved to do things banks can't, and it's a whole spectrum of new interesting products that are available for borrowers that deal with things such as builders going under, needing to replace builders, cost increases, enabling us to re-lever projects and transactions. And I think across our portfolio, $300 million worth of our loans in the last 4 to 5 months, we've had facility upsizes on. And we've been able to deliver those facility upsizes in as little as 2 weeks, just because of the credit processes that we've built.
And so, sorry, Andre. So Nick, it's really, I guess, your niche skill set that allows you to take which a traditional lender would perceive as being an overly risky position, because you're able to understand the exposure of the deal with a greater deal of, I guess, granularity and knowledge. Yeah. Yeah.
Look, it's good to good to see Drew back on, and I'm sure Drew will agree with these thoughts. But as a private lender, we look at risk differently from a bank. But banks are there to fit transactions within a basket of risk. So banks are putting constraints around risks they do and don't like to take. What's happened with the emergence of and the growth of private lending is we're able to price risk all up and down the risk spectrum. So once again, the distinction between the period of the financial crisis versus today, there are lenders and financiers that are able to package up and invest in many of the risks that are being, many if not most of the risks that are being encountered in the market today. And certainly where you're seeing banks go risk off, the opportunities are with private lenders to take risk, to price that risk effectively. I think I see on the agenda that you've got some of the advantages, disadvantages of private lenders, but that's all a part of this equation of risk taking and our ability to, and the way we approach it. We're not scared of it.
Okay. So through to bring you up to speed, we've had a bit of a background about where the industry is currently playing, the construction sector from Duncan, and Nick's now provided a bit of a feel for where non-bank lenders fit into the scheme of things. So maybe you'd want to just add a comment. So welcome to the panel, first and foremost. Sorry about the technical difficulties there, but just to bring you in, where does Molus play, or MA, and how do you see yourself as being able to provide a tool in the current sector, as a non-bank lender?
Yeah, thanks, and sorry for joining late. So I think within that framework, as was just mentioned, all lenders, non-bank and bank, operate within certain frameworks, and it depends upon the source of capital ultimately. At the end of the day, we are custodian of other people's capital, making the decisions to lend to borrowers. And I guess there are 4 types of capital sources. There's balance sheet, there's institutional capital partners, there's wholesale funds, which is typically sophisticated investors, and then there's retail funds, or funds for retail investors. So they're principally the 4 main sources of capital, and each of those capital sources have have their own mandates, differing requirements, different risk appetite. We think about credit, real estate credit or real estate lending. In this market, in most markets, most cycles, it is regarded as a defensive investment strategy. So it's about preservation of capital, which is why we're not playing the equity space. We're playing in the more risk-adverse credit space. So we at MA Financial, we've got a series of funds at the moment. We've deployed about $2.5 billion over the last few years, and that fund is about $1 billion now of other people's money. And we're across all those platforms. So we have our own balance sheet, which enables us to underwrite transactions on risk measures that we think are appropriate, and it changes depending upon that capital source. So within Stoke Capital Partners, you know, there's a huge range of different requirements that they have, and some are, you know, want to really lend to those big shiny assets, and others, you know, want to take a sort of a more higher returning position. So it does vary. The important thing, I guess, is having capital that can actually play through the cycles. You know, we're always in a cycle. The current situation is something that, whilst the influences or the causes of cycles may change, the outcomes of cycles are quite often very similar. So it's been having a diverse range of capital sources that can play, you know, at any time in the market, and knowing when not to play as well is critically important.
So, you know, from the borrower's perspective, and Charlie, maybe we will go to you. From a borrower's perspective, what should we be looking at? You know, how can they set themselves up for success when looking to access funds at the moment? How do they approach you? What do they need to be able to show to you to be successful in the current market?
Well, I think the most important thing is to have a comprehensive package of information about your project or your property, so that we can do our due diligence in a sort of quick and efficient manner. So a lot of times we get loan proposals of all different varieties. So it doesn't mean we won't look at them. It just means that the process takes longer. So if you've prepared yourself well and have current valuations, quantity surveyor reports, feasibilities, cash flows, all of those sorts of things available, we can respond very quickly in terms of getting a sort of high-level understanding of the project and its risk metrics, and then we can come back with some preliminary terms on that basis. But having your information together is the sort of key to getting a quick response.
Yeah, I might just add to that as well. I think it's really important to be realistic about the market. Trust in your lender. You know, this is a partnership that you're going into. There are different, obviously, priorities in that partnership, but we're all focused on the same asset and the same outcome. So having a trust in your lender, in that they're going to make the right due diligence inquiry, make the right assessments, and if you're concerned about particular areas of the project or of the proposition, I would actually be quite forthcoming about it, because we expect that there are problems. We expect that there are challenges in the market. We expect that valuations tend to be backward looking, and quantity surveyors are not always keeping up with changing in pricing, etc. So we're going to be thinking about all those things. So I always just highly suggest that you get ahead of the game and you know, just be open in that communication and identify what's good about the project and where are the challenges for the project. Ultimately, I think, you know, from our perspective, whilst, you know, you do have risk return adjustments, you're pricing to your cost of capital. If you like the deal, you do the deal. If you don't like the deal, you don't do the deal. So, but we're going to usually uncover any sort of challenges about the deal anyway.
So it's not the time to be hiding things that should be disclosed.
Never. Look, it doesn't help. You know, most of these, as I said, it's a partnership. It's a relationship that will span, you know, if it's a construction facility, it's going to be 18 months, 2 years, whatever it may be. And in that time, there will be challenges. Builders are clearly having a lot of challenges at the moment. That flows on to many other people, flows on to the financiers, flows on to the borrowers, of course. So you've got to be able to deal your way through that and have a lender that's going to respond well to it, and not be predatory in its mindset, be helpful, identify problems for you as well. I mean, lenders typically have more touch points in a development market than a borrower will. You know, a borrower will do 1 or 2 projects. We've got 80. So we see a lot more data coming through. We try and get ahead of the game by helping our borrowers through these risks, you know, extending facility maturity dates and facilitating payments direct to suppliers, et cetera, et cetera. So all those things are there to try and mitigate the risks before those risks manifest into something that's worse for everybody. So communication and being honest and open, you know, pays dividends throughout the life of the project.
No, thanks, Drew. Duncan, do you want to add anything from, you know, your role as manager on some of these assets that might be struggling? You know, what are you seeing in the market right now where people, or how are you helping people that are struggling in the market right now?
Yeah, look, where we're helping, you know, for the BDO clients, BDO clients are typically upper mid market size clients. They've got debt somewhere between sort of 50 and 70 to 90 million on average. What we're seeing is, you know, projects that would have been funded 3 years ago are now a little bit more marginal as property values have come off and construction costs have gone up. And we're also seeing clients who have historically gone to the big 4 banks are now sort of casting around as to, well, the big 4 banks aren't going to do my deal. What should I do now? So I guess I'd like to ask the panel really, how does a prospective borrower come to a Centuria Bass or come to an MA Financial? Is it through the website, or is it through a broker network, or how should they go around approaching you guys?
Well, look, we rely a lot on brokers, but we also have a direct channel for originating credit. So borrowers reach out to us all the time, and we have obviously a mix of that and repeat business. But typically, borrowers, obviously, the first port of call for most borrowers is to go to their bank. That's habitual. But there are now more and more lenders that have permanently, more and more borrowers that are permanently in the private lender sphere. So we're seeing more and more borrowers that are in with private lenders, and there is obviously a pricing premium for private debt, and it's effectively what you're getting is the service. You get what you pay for. You're getting the service level that comes with having a sophisticated private lender that understands the risks of your project. And the reason they're understanding the risks of your project is so they can react quickly when something changes, such as your building cost increase. So the questions you get from a private lender and the team understanding and intending your PCGs, that's about us understanding the risk and being able to react when something changes. So in terms of how borrowers approach us and come to us, we're very, very comfortable with sort of the multi-channel origination that we have, which is direct, but still most borrowers tend to use brokers, and there are good brokers, and there's a whole variety of them. There's literally thousands of commercial brokers out there, and we tend to, I'm not sure about Moelis, but we sort of tend to have a dozen or so brokers or 24 brokers that understand us quite closely and understand our credit criteria, understand how we react and trust us. And then we end up in processes with the brokers that better understand us. We don't obviously have relationships with 2,000 commercial brokers.
So in that instance, for the borrower, it's really about finding a broker who understands their unique set of circumstance and then can find the lender best matched to those circumstances.
Yes and no, and obviously there's a lot of repeat business, and you get more and more as the market's grown. We've found more and more borrowers comfortable that they understand the private lending market and are comfortable to come direct. So that's increased over time, but we make use of brokers as well, effectively.
Yeah, we're
Drew,
the same. You know, you can't build a business of scale and just rely upon just borrower relationships. You've got to develop new ones all the time. Brokers add a lot of value. They're in the market all the time. Lenders' own appetite for investment does change quite rapidly, and it might change upon whether you're sitting on a lot of cash or whether you're short cash. That does change as well from lender to lender. So you know, we're operating in a highly competitive environment, which is fine, and I think that's healthy and good. So I think brokers, you know, have the good ones, and like in any sector, there are good ones and bad ones. But I think that they tend to have their finger on the pulse as to who's got capacity and at what risk appetite.
And I think just adding to that, all of the funds have different. We act quicker than banks. You know, we'll change our credit criteria, change our risk weightings to certain types of assets. We'll be overweight one region, underweight another. So that takes brokers to understand the landscape of lenders out there, and there are very few private lenders who are all things to all borrowers.
Certainly, we are seeing borrowers who've only ever borrowed from the ADIs now seeking out as this non-bank lending market has continued to mature. And in itself, it describes a very broad church of people. There are good ones, institutional quality ones, and then there's ones that, you know, can operate out of a garage technically. I think we're seeing a lot of people who've only borrowed from ADIs now thinking we need to expand our borrower horizon and capacity. So we are seeing more and more of those groups come through.
We also have seen, I think we've seen a range of, just echoing Drew's comments, we've seen a range of borrowers which traditionally have only used ADIs, the higher quality developers that see private lenders. Most developers, mid to larger developers, now have a few private lenders in their quiver that enable them to respond quickly to opportunity. Certainly things that banks can't do as effectively as we can, which is process transactions quickly within a matter of weeks if there is an opportunity. So, or if there's a problem on a project that can understand that more quickly. So obviously, if you're a developer that has grown beyond one or two projects, you probably do need a couple of private lenders that you have relationships with and that you've built relationships with over time. It's certainly worth investing in that. And yes, it's higher pricing for private debt. That's a part of the converse of having greater service is cost and the attention you get. But that's led most developers of scale to have a number of relationships with privates. So we're finding that more and more, where we sit there with other private lenders on a funder panel for significant developers and successful developers.
I think flexibility.
It's actually hard to do the pricing comparator really, because it's rarely like for like. You know, the non-bank space is playing the space that the banks used to play in. You know, 85% LTC, 75% LVR, that sort of space. And the banks obviously are far lower than that level. So once you factor in the higher cost of equity or subordinated debt and the complications with that, overall, you know, the pricing differential may not be that extreme. I think overall it still is more expensive probably, but potentially more dependable and an easier thing to access as well.
Charlie, you're going to add something?
Yeah, well, the main differential I think is flexibility, in that because we're able to sort of dig into the sort of fine grain of each project, and we monitor them very closely and develop that relationship, that partnership relationship with our borrowers, we can react to changing circumstances and get an understanding of, you know, because of our sort of understanding of the project, we can take a view quite quickly and adapt our loan parameters to suit whatever situations might arise in a project. Whereas your traditional sort of bank relationship, if you had a all-encompassing sort of banking relationship where the bank basically held security over everything down to your underpants, then you were able to get flexibility in those circumstances. But if it was just a single sort of project finance arrangement, the bank is sort of less accommodating in terms of flexing the arrangements if things sort of change. And that's where in the past you would have seen borrowers then have to go to a mezz lender or a pref equity type scenario to solve those problems. So here you're not having, you can have that all from one source of capital.
I'd have to say probably a third of our loan volume at the moment is purely timing driven. It's purely the fact that that borrowers are unable to get through a traditional bank process in time to either satisfy the settlement of a transaction they're on or meet a refinancing date. Once again, most borrowers start off with a bank-driven process through their broker, and many of which end up with private lenders. But probably a third of our origination volume is around timing, and definitely the other 2/3 is around flexing terms, higher LVRs, specific issues that fall outside of standard bank criteria, loan to costs, pre-sales levels, everything that the borrowers are familiar with.
Now, this might be a loaded question, but where do international funds come into it? International lenders, is there a place for them in the Australian market?
Certainly there's a place for them. Australia is becoming really attractive for institutional capital. They like the fact that the mortgage market here is very robust. It's very tried and tested, very mature. Our markets generally are very stable, and access to security is very good. So they like it from a fundamental perspective. So I think we'll continue to see more and more institutional capital play in this space. The questions that the borrowers need to be asking themselves is, are they here to stay? How quickly can the money, the commitment to lend be made available? Is there drawdown risk? So, we know that you've got to pay a builder pretty quickly. Is that money going to flow freely, or are there going to be hiccups? And who are the decision makers? How much do those decision makers know about this market, and what's going to influence you as a borrower? If your builder has a problem, is your lender going to understand that problem alongside you, or is this going to be an education process all the way through? Now, a lot of insto investors, institutional lenders, will actually partner with local managers such as ourselves because they don't understand it themselves. They like the credit space, they like the returns, but understanding the intricacies of managing it is something that they're not geared up for. But there, I think, really important questions for a borrower to be asking, of that sort of capital.
I think that's absolutely right, Drew. Fly-in briefcase bankers can be a catch-22, and you do need to have that permanent or that commitment to a local team to be properly servicing the market.
Could I just ask a question, I guess, on a slightly different topic at this point? Obviously, I'm in the stressed and distressed space when I'm dealing with these borrowers in a restructuring capacity. And what we've seen for the last few years has been almost a merry-go-round or a game of musical chairs, as a non-performing borrower might refinance from a tier 1 lender to a tier 2 lender to a tier 3 lender to a tier 4 lender, and the music stops as off the back of basically capital appreciation has allowed that to happen. And obviously we've gone through an extraordinary period of capital appreciation in Australia, and that not in all sectors, but that has largely stopped for the time being. And that, I guess, has meant that some of these distressed borrowers that I deal with haven't been able to make that next jump to another lender because capital appreciation is not going to save them. How are you addressing, in your sort of assessment of loans, the fact that capital appreciation may have stopped for the time being? Is it a factor, or are you just addressing the loan on its existing merits?
Yeah, you should never factor in continuing capital appreciation into a loan assessment. It's the critical. There are two critical elements in making a decision to lend. That is, have you assessed the value correctly? So your value denominator in your LVR calculation, is that correct in the first instance? I think where most lenders go wrong is because they thought they were starting at 65%, they're actually starting at 80% or something like that. And then what is your exit? And if your exit is simply a refinance, I think that's a really good point that you raised, Duncan. And, you know, if you'll eventually run out of lenders, that's the sort of, and if we're always relying upon being refinanced from another lender, a lower tier lender, then they're unlikely to do that transaction. And indeed, you know, if we've seen that this loan has been already refinanced through, you know, a few of the majors, then we're probably unlikely to participate in that facility. That said, there are still solutions, but whether it's just a vanilla type of loan, you know, that's probably, in that sort of circumstance, will probably not be one for us. But if the exit is something other than that, then you know, we're keen to participate.
There are a couple of things within that basis of valuation that you're talking about. I don't know that many borrowers purely reliant upon significant increases in the market. Part of what you see is the basis of the valuation. So you're seeing developers, lenders that may have been prepared to take the risk of achieving a DA or even in some cases zoning, leading to some of that capital appreciation. But certainly, if you're reliant upon capital appreciation as a fundamental method to exit the loan, you're probably off on a pretty risky start. The points that Drew was making about the merry-go-round of lenders, one thing I actually would highlight is that merry-go-round of lenders didn't really exist 12 years ago after the financial crisis, because in that period, the merry-go-round of lenders was very few private lenders, and the merry-go-round generally ended up with some form of enforcement action. So you guys getting in there sooner than you do now. So now there's a whole, there are other alternatives, more expensive alternatives, and the last stop on that merry-go-round obviously is getting equity-style pricing, much higher pricing, and certainly significantly higher risk and reward outcomes. Certainly though, in terms of capital appreciation or valuation appreciation, lenders, borrowers have to make sure that the basis upon the valuation they've got is reasonable. We're not taking old valuations. Current valuations are important, but also the assumptions that go into those valuations. And certainly, you're seeing in areas where there's less liquid stock, if you only have a number of comparable observations for the comparable sales prices, they're getting discounted. So I think we're certainly all looking at the quality of valuations a lot closer. The market is certainly more complex, and rising tide is not going to lift a whole lot of C and D grade projects right now.
Okay. And on that note, given that today's session is really to demystify the non-bank lending space for our clients, the concept of loan to own is a little bit intimidating from a borrower's perspective if you're just sort of dipping your toe into the non-bank lending space, and it was particularly prevalent sort of 3 or 4 years ago. How does that occur any longer, or is that something for, I guess, one of those lower tier lenders that we sort of touched on earlier?
I mean, you see that in the lower tier perspective. We don't want to deliver your project, right? If you're a developer, we're not set up to develop your 50-unit residential development. We certainly want the developer that is primarily responsible for the delivery and dealing with all of those risks day to day. We want them doing it, but certainly we're going to put a lens over that process of delivery. And we're going to be putting disciplines around that project to protect our capital, which normally is greater than the developer themselves have at risk in the project. Loan to own, we don't do it. There are certainly certain lenders that do it, but that's all around being at that riskier end of the spectrum, taking greater risk, taking levels of equity risk, and it's certainly a valid approach to borrowers who want to raise additional capital and don't have capital. I think there are certainly many loan to own players that go about it very well, and they take a partnering approach to the projects. We're not one of those loan to own lenders though. So
yeah, look, I echo all that. It's very short termism. You can't build a strategy or a business of scale if you're going to be that sort of lender. In our opinion, we're quite the opposite of that. You think about all the development loans that are out there that we have, and we've facilitated so many extensions and support mechanisms that we weren't obliged to, but we wanted to support the borrower, support the right outcome for the project. That's quite the opposite of predatory style lending. But I do know, loan to own, it's a bit of a misnomer. I mean, if you needed to take control away from a borrower, corporations law sort of governs how you must act and what you must do in that. It means, I think loan to own actually means sort of coming back to the negotiation table and maybe enforcing sort of defaults as soon as you can. But there are limitations on what you can and can't do as a lender, which is good for everybody.
Okay.
yeah, but probably the other side of that is that once again, 10 years ago, without the growth of the private lending market, borrowers had less choices if they required significant amounts of equity capital. So borrowers on larger developments wouldn't have had the ability to have the stretchy LVRs that they're achieving today on some projects, and that's enabling them on good projects to actually develop them without introducing a big brother, without diluting the amount of capital, the amount of equity they need to in their project. So once again, the advent of private lenders all up and down that spectrum of LVRs, and I think we saw private debt markets cap out at probably 75 to 80% loan to value ratios on certain types of projects. We saw that happening back in November, December last year. They're probably 5% down, but we're at least 10% higher than where the banks are prepared to go at the moment. So that is preventing the dilution of equity that developers have in their projects.
Okay, so I'm just wondering if we can, put our minds back to the overall industry. Duncan gave us a brief snapshot as to where he sees this at. Nick, where do you see this going? Are we in for a ride at the moment, and this will keep on going, or do you see the conditions improving? Where do you see the construction industry going in the short to medium term?
Well, once again, we're a bit like Drew. We're across, I think, 52 individual positions. We're funding development Australia-wide. Personally, I think we are seeing undersupply. We're seeing the intersection. We're not going through a financial crisis now. We haven't built millions of homes in the Nevada desert, which no one wants to buy. We're in a situation where we are seeing the 30 years of compressing cap rates being reversed because of interest rate rises. So we're seeing a reduction of liquidity, but at the same time, Australia has gone through a generational construction crisis as a result of the floods on the East Coast. We've never seen this pattern of weather events before. Most projects are running 3 to 6 months late. And that means all of us lenders have, if you've got an average portfolio duration of 18 months and the average project is 4 to 6 months late, that means your book on a static basis has increased by 25%. So we've got more capital deployed just holding the projects that we're supporting at the moment. All of those factors are seeing supply adjusting. So personally, we're thinking that there are going to be rental increases. We're seeing migration pick up. Australia's housing stock, we add 150 to 200,000 houses a year, and we're seeing ourselves certainly at the lower end of that supply. We're seeing a lot of developers react really effectively. They're going out and looking for interesting sites that they can look to bring on supply next year. So overall, absent some kind of incredible crisis in Europe, which is possible, it's hard to say what's around the corner, but the intersection of all of those supply constraints, we're in the middle of that right now, and that's adjusting supply. So certainly we see rates balancing lack of supply next year, and ultimately we do see a floor on price falls, and we do see there's not a lot of feasibilities stacking up right now for new construction. So we're seeing more bridge loans at the moment. We're seeing some developers get ready, but certainly you would expect that rent rises equate to yield increases that adjust for rate rises, and we obviously see some sort of balance coming in the next 6 to 12 months.
Just if I can just add on the actual construction side as well, amongst the builders that we're working with at the moment, we're seeing that the cost pressures on them are certainly starting to ease. So we had that the pinch point sort of earlier in the year with sort of disruption caused by Ukraine, the COVID lag in terms of supply chains and logistics problems with shipping, etc. All of those things are starting to free up. A lot of suppliers and manufacturers and what have you are finding they're finding new avenues into Australia. So whereas previously we were sort of, you had builders who were using products that were sort of coming from Europe or China, they're finding that there's alternative suppliers for those products in the US, for example, and other parts of Asia. So those sort of things are leading to an easing in cost pressures, and we're seeing that sort of starting to flow through in terms of trade prices and what have you. At the same time, the amount of construction starts is definitely in terms of the residential sector has dropped away significantly. So the pressure on those sort of residential trades is now sort of easing as well. So a lot of our builders have said, they've never had, well, in the last sort of couple of years, they haven't had subcontractors calling them for projects. It's been the other way around. Whereas now the subbies are starting to get on the phone and asking the builders where their next job's coming from. And the subcontractors typically don't look more than 3 or 4 months ahead. So it gives you a sort of leading indicator of where trade prices are heading. So I think on the cost side of things, that's going to start to ease. So it's not going to reverse at any great rate, but it's certainly taking the heat out of the market.
I think there's a huge amount of uncertainty out there that's going to continue because there's mixed messages all over the place. And I agree with what Nick and Charlie have said. On the flip side, if we think about residential, I think where most of the market is concerned about is the fact that 10% of the entire mortgage market is on a fixed rate of 2% or less, rolling off over the next 24 months. And those people will be rolling off an interest rate 3 times what they're currently paying. So that's pretty scary. I think that's particularly scary for potentially off the plan purchases. People who bought a year ago, bought something for 1.2, thought they could borrow $1 million. That maximum mortgage capacity is now dropped by 25%. So that's a big number. If you thought you could borrow $1 million, you can only borrow 750 grand now. I don't think that has filtered through as yet. So that could be a concern. And also, I heard from CBA the other day that it takes 90 days for a change in the interest rate to affect the borrower. So for them to have to actually pay that increased rate. So that means that of the 2.5, only 50% of the increases in the RBA cash rate have actually so far filtered through to the market. So there's a lot more pain to be had there. But you've got to be very cautious about just applying macro data to micro markets and decisions to lend against individual assets. They're all different. Some markets have increased by 40%. Some markets have hardly increased at all. The apartment market has been pretty flat. To Nick's point, we've had no immigration. That's probably going to come back and fuel that growth. We're seeing increases in rental rates, as Charlie mentioned. So there's sort of positive and negatives. One thing that we do know is there's going to continue to be uncertainty. So I don't think, yes, a lot of those cost pressures are coming off, but we're still in an inflationary environment. So it's not like we're in a recession where costs are being forced down, and prices coming down are usually pretty sticky. So they take a long time to come down. But, if you've got a lender, when we make a decision to lend against a construction deal, for instance, we assume, even before we've gone into it, we assume that a builder's going to go broke. We assume, I'm sorry for all the borrowers out there, but we actually assume that something will happen to the borrower. Borrowers die, unfortunately. You've got to assume pre-sales fall over. So you assume that all these things, you've got cost increases, you've got delays, and you assume that all those things happen concurrently. So it's not one or the other. And if you make those assumptions and you're still happy to lend, that when these things happen, when builder gets into trouble, you're not surprised by it. You know what to do. It doesn't shock you, and you know how to support the borrower very quickly. And I think time is of the essence, when there are problems. So there will continue to be uncertainty out there. I think we'll see less non-bank lenders in the short term, because I think some of them will be hit with redemptions. If you've been offering your investors a fixed rate loan or fixed rate investment return, and all of a sudden that fixed rate is starting to look pretty average compared to the increased cash rate, then they're going to start redeeming. And most of the non-bank lending world operates on an open fund type basis where people can ask for their money back, and lenders have less money to support new growth. So again, that's going to mean there's going to be a flight to the better quality lenders, those that have sort of set themselves up to fund through cycles and to continue to grow. And so that's creating a capital supply shortage, certainly in the short term.
I think that was actually a really good tip, Drew, for borrowers out there. Those projects need to be demonstrated to us to be robust on a standalone basis. So each of those areas of diligence, being able to sustain significant increases in pricing if the builder goes under, being able to have all the elements, being able to have a good sales strategy, having the right agents appointed, every element of those projects needs to stack up for us to get excited through credit. And one of the other issues I think around this uncertainty is right now, if you're seeking funding, if you're a borrower and you are seeking funding, we come into this traditional Christmas Australia Day period where a lot of funders, a lot of people go on holiday, and traditionally, if you need capital or you need an increase, anytime between now and about March next year, you need to actually be getting prepared for it now. So we're getting into this process where you've got to have credits, even for private lenders that operate much, much quicker than the banks. You need to be actually processing things through. You need to be very well prepared. And literally, if you're not in a credit process within the next 3 to 4 weeks, you'll be missing this year. So I think that's important for borrowers to keep in mind.
We always keep quite a bit of powder dry in the lead up to Christmas. We often see deals coming in December. Happy to facilitate those. But yes, as Nick mentioned, the non-bank lending market can respond a lot quicker. We've funded deals within 5 days of hearing about them. So it can be done. You just got to, you just got to have all your info ready and make a quick decision.
I'm going to have to cut it short there. It's been fascinating, but I take a lot out of this. Not having had much interaction with the non-bank lending space, I've learned a lot today, and I'm sure our listeners have as well. The fact that you are quicker to market, that you understand the market better than maybe the international lenders, that you're quicker to process change in your borrowers than maybe the traditional lenders. You can process loans within 5 days. I think that's all relevant to our listeners, especially in the current market with the industry where it is, with the construction sector where it is. So I've certainly taken a lot out of today. Unfortunately, we're running out of time to continue this, but look, people will get an email with your contact details, so I'm sure they can reach out to Nick, Charlie, and Drew, Duncan in their own time. So with that, I just want to wrap up today. Thank you, Nick, Charlie, Drew, and Duncan for making your time available today. Got a lot out of today, and yes, on that note, thank you. For our listeners, if you had questions, didn't write them down in time, look, please reach out to myself or Duncan. We'll collate the questions and we'll pass them on to the relevant people. On your slides, you can see on your screen, you can see now the next webinar on the 29th of November, just doing a wrap up of the year and looking forward to 23. When you log off, there will be a short survey. We'd really appreciate your feedback, how we can improve these sessions. We're looking at the program now for next year, so if you have any suggestions to what we should be including in our webinar series for next year, please do let us know. Outside of that, we thank you for joining us today. And once again, thank you to our panelists, Nick, Charlie, Drew, and Duncan. Thank you very much. We'll see you next time.
Definitely.
Thank you.
Bye-bye.
Thank you.
Thanks, guys.